All right, let's go. Starting off with recorder communication, let's get a good understanding about this. First question is about benefits of audit planning. It's a very easy question, so we can quickly get done with this. What are the benefits if you do audit planning well? What are some benefits here? So let's look into that. Looking into the benefits of audit planning here. So let's highlight the points that are the most key points that you have to not forget to write in your answer. First one we look into is focus. That you will devote appropriate attention to important areas. That is the focus. That you will devote appropriate attention to important areas. That is the benefits of audit planning. Second, problem solving. It helps the auditor to identify and resolve potential problems on a timely basis, right? It's not about the problem, it's on a timely basis. Okay. So on a timely basis. Third one, organization. It helps the company to properly organize and manage the audit engagement. Helps the company to organize and manage the audit engagement. And next, the right team. It assists the selection of the choose the right team with the right skills and experience. Okay, it helps in the selection of the engagement team members with appropriate level of capabilities and competence. Okay, it assists in the selection of engagement team members. That you will select the right kind of people. If you know, plan it better, you will select the right kind of people. Next, it facilitates the direction and supervision of engagement. Okay, and next it assists where applicable in the coordination of work done by expert. Wherever application, it assists in the coordination of work done. So wherever it's applicable, there's a coordination of work done by experts that might help there. Okay, so it helps in coordination, it helps in direction and supervision, in selection, in organizing and management on a timely basis, and devote appropriate attention to important areas. Okay, so these are the benefits of audit planning. Okay, devoting appropriate attention to important areas to identify and resolve potential problems on a timely basis, organize and manage the audit. It assists in selection, direction and supervision and coordination. Okay, so these are the benefits of audit planning. Devote appropriate attention to important areas. It helps the auditor to identify and resolve potential problems on a timely basis. It helps the auditor to properly organize and manage the engagement. It assists in the selection of the engagement team members. It facilitates the direction and supervision. Also, it assists where applicable in the coordination of work done by experts. Okay, it helps where applicable in the coordination of work done by experts. So coordination, direction, supervision, selection, organizing, management, timely basis, and devote appropriate attention to important areas. So okay, let's look into this here, Shivashri. What are the benefits of audit planning? Hmm. Okay, to start off, next. Yes. Hmm. Hmm. Very good. So this is pretty much about this. Okay, moving on now. Let's look at the next question is about seven audit risks. Okay, so let's look into the audit risk here and let's get a strong understanding. Okay. Next we'll look into benefits of audit planning is done. Next describes seven audit risks. Okay. So now let's look into the audit risks here. What about the audit risks? The first audit risk here is again it is a new client. Let's look into this here. What is the first risk? That it is a new client. That is the first risk, that it is a new client. As we can see here, and it's a new client for you. So whenever there's a new client, there is a Lot of problem initially because you're not familiar with the accounting policies, transaction and balances. First, this is the problem that you're not familiar. Okay, the problem is that you're not familiar really. Okay, the team is not so familiar with the accounting policies, transaction and balances. There is an increased detection risk. There is an increased detection risk. What is the solution over here? Okay. PN and Co should ensure a suitably experienced team. There should be a suitable experienced team is assigned. Also, adequate time should be allocated. Okay. Adequate, eventually, a time should be allocated. Suitable experienced team is assigned and time should be allocated. Okay. Experienced team is assigned. Adequate time is allocated so that everyone gets an understanding. So that is about the new client. That is done. Next, we look into the second one here. Is that they supply they take a goods from a supplier which is in South Asia, and these goods are shipped to the company's warehouse, and it takes in transit 2 weeks in transit, right? There's 2 weeks in transit. Okay, 2 weeks in transit. There are 2 weeks in transit. So record a purchases go from South Asia and the goods are in transit for 2 weeks. They are in transit for 2 weeks. So what is the solution about this? Okay. Therefore, at the year end, only goods which have been received into the warehouse should be included in the inventory balance, and a respective payables balance should be recognized. Okay. So what happens over here is that therefore at the year end, only goods which have been received into the warehouse should be included. So the risk is that you will have a wrong inventory. So what you should do is the thing is that only goods which have been received should be included in inventory. But what they might do is they might or might not record it correctly. So at the year end, there's a risk that the cutoff of inventory, purchase, and payables may not be accurate. Cutoff means it's not recorded in the right period. So what is the solution? What you should do? Do cutoff testing, right? Detailed cutoff testing do for all the goods just to ensure that the cutoff is accurate, right? You want to ensure that the cutoff is accurate, do detailed cutoff testing. What you should do is detailed cutoff testing. What you should do is detailed cutoff testing. Okay, what you should do is detailed cutoff testing. Third one, perpetual inventory counts, right? The company does continuous inventory counts all the year, right? Not one big count, right? Continuous inventory. So here it's given. And the record the render does not undertake a year-end inventory count but carries a monthly perpetual count. So see, perpetual count, the problem is that it keeps happening throughout simultaneously. So if the continuous inventory counts are not complete, then your inventory can be incorrect. So see, when you do a continuous count, you keep counting one part here, one part there, you keep recording. So the risk is that the company takes a continuous inventory perpetual count. So under such a system that all part of inventory is counted at least once. So there's a risk that your inventory may be under or overstated if the continuous count is not complete. Okay, so what is the solution over here? The solution is the completeness of the account should be reviewed. The completeness of the account should be reviewed. In addition, the level of adjustments made to the inventory should be considered to assess whether reliance on the inventory records at the year end will be acceptable. Firstly, the completeness of the continuous inventory count should be reviewed. So the completeness should be reviewed. In addition, the level of adjustments made to inventory should be considered to assess whether reliance can be placed on the inventory, whether it's acceptable. So firstly, the completeness should be received. The completeness should be reviewed. And second, the level of adjustments made to the inventory should be assessed. So first is the completeness of the count. Just make sure all the areas have been counted. Second, the level of adjustments to the inventory, the level of adjustments should be considered. Second, the level of adjustment should be considered to assess whether reliance on the inventory records at the year end will be acceptable. Firstly, the completeness of the continuous inventory count should be reviewed. So firstly, the completeness of the count should be reviewed. Second, in addition, the level of adjustments made to the inventory should be considered. First is the completeness of the count should be reviewed. Second, the level of adjustments should be considered. Okay, first is the completeness of the count should be reviewed. Second, the level of adjustments should be considered to assess whether reliance on the inventory records at the year end will be acceptable. The first is the completeness of the count should be reviewed. Second, in addition, the level of adjustments made to the inventory should be considered. The first is the completeness of the inventory count. Second, the level of adjustments made should be considered. The completeness of the counts and the level of adjustments needs to be made. Yeah, the completeness of the counts should be reviewed. In addition, the level of adjustments made to the inventory should be considered. So one is the completeness of the count, and second, the level of adjustments. One is the completeness of the count, second is the level of adjustments. Okay. One is the completeness of the count, second is the level of adjustments. One is the completeness of the count, second is the level of adjustments. Right? The completeness of the counts should be reviewed, and second, the level of adjustments made to the inventory should be considered. Next, we look into inventory valuation. So they are saying is, and an errors identified are adjusted. Manufacturers regularly bring out new models. When this happens, the old models will be sold at a significant discount. So whenever you bring new models, old will be sold at a significant discount. Now, why is this a risk? Because then some of your inventory may be overstated. Okay, will be sold at a significant discount. Okay, will be sold at a significant discount. What is the solution to this? The solution to this is inventory will be overstated. If these have not been written down, inventories will be overstated. Okay, if these not have been written down, inventory will be overstated. If these have not been written down to the lower of cost or NRV, if you have not written it to the lower of, if you have not been written, if you have not written it to the lower of cost and NRV, okay, if you have not written it to the lower of cost or NRV, your inventory will be written down. Okay, if these have not been written to the lower of cost and NRV, right? If these have not been written down to the lower of cost and NRV, your inventory will be overstated. And what is the solution to this? What is the solution to this? Review the aged inventory listing to identify items which need to be discounted. Review the aged inventory listing. Second, perform a detailed NRV and cost testing to ensure the old items are valued appropriately. Now, okay, to ensure the old items are valued appropriately, perform a detailed NRV and cost testing. Review the aged inventory listing to identify items which need to be discounted. Review the aged inventory listing. Okay, review the aged inventory listing. Okay, review the aged inventory listing to identify items which need to be discounted. Okay, review the aged inventory listing to identify the items which need to be discounted. Okay, so review the aged inventory listing to identify items which need to be discounted. Okay, and perform the detailed NRV and cost testing. Perform detailed NRV and cost testing. Okay, next what you should do is perform inventory and cost testing. Perform detailed inventory and cost testing. Um, so that is about this. This is when whenever you bring a new model, the old will be gone, and when old, I mean old will be sold at a discount then. Then when old is sold at a discount, then you may have to sell it for lesser, and you have to record the inventory at lower of cost and NRV. And you have to value the inventory at the lower of cost and NRV. Okay, so review the age listing and perform detailed NRV and cost testing. Perform detailed NRV and cost testing. That is about this. Okay, next we'll look into here. What about this? Perform a detailed NRV and cost testing to ensure the old items are valued appropriately. First is review the aged inventory listing to identify items which need to be discounted and compare it with the inventory allowance made. Next, perform detailed NRV and cost testing. What you should do is perform detailed NRV and cost testing. Perform the detailed NRV and cost testing to ensure old items are valued appropriately. One is review the aged inventory listing to identify items which need to be discounted and compare with the allowance made. Second, perform NRV and cost testing. So this is about inventory valuation. Moving on now. Manufacturers regularly bring out new models. This is done during the year. Next, during the year, introduce a bonus. So whenever there is bonus, there's a chance of manipulation, right? So bonus scheme has been introduced, right? So whenever there's a bonus scheme, there's a chance that they will do manipulation. Okay, so this may lead to cut-off errors, trying to maximize their bonus. Right. So what you should do is revenue and receivables should be overstated. Whenever there's a bonus situation, revenue and receivables should be overstated. And what is the response to this? Right. You should do increased sales and cutoff testing will be performed. increase case sales and cutoff testing you should perform. And second, uh, external confirmation of receivables to confirm that customer existed and present a valid amount. Second, what you should do, external confirmation of receivables to confirm that the customers exist and represent a valid amounts due. Okay. Second, external confirmation of receivables to exist that the confirm that the customers exist and represent a valid amount due. That is the next thing to external confirmation of receivables. You should need this. That is an external confirmation of receivables to confirm that customers exist and represent a valid amount due. As the customers exist and they also represent a valid amount due. That is about the response. So what is the risk here? See, whenever there's a sales related bonus, there's a chance that, they will try to create some fictitious employees. They'll try to maximize the current year bonus. As a solution, revenue and receivables should be overstated. Your revenue and receivables should be overstated. Increase the sales cutoff testing and external confirmation of receivables to confirm that the customers exist and represent a valid amount due. What also you should do is do an external confirmation of receivables to confirm that the customer do actually exists and represent a valid amount due. Very important. Okay, that is about this. Next, we have a recorder has a policy of revaluing its. Okay, there has been successful. These have been successful and has increased by 15% in the last few months. Right, it has been really good for them. The level of receivables is higher than last year, and there are concern about the creditworthiness. So, see, some of the people will never pay only. Right, you may have just have to make more allowance because you have increased the receivables a lot, and some people there's a chance might not even pay. Right, there's a chance that some people may not even pay. So there's a risk that some of the receivables may be overvalued. Right? There's a risk that some of the receivables may be overvalued, right? If not recoverable, and therefore an adequate allowance for the credit losses is not made. If they are not recoverable, an adequate allowance for credit losses is not made. That could be a risk. What could be a risk that an adequate allowance for credit losses is not made? What could be a risk that an adequate allowance for credit losses is not made? Okay, there's a risk that some receivables may be overvalued, and if they are not recoverable, then adequate allowance for credit losses is not made. So what you should do is you should start extending the post-year-end cash receipts. Uh, Extend the post-year-end cash receipt testing and a review of the aged. Extend the post-year-end cash receipts testing and a review of the aged list of individual customer balances to be performed. Right? Extend the post-year-end cash testing, for receipt testing, and a review of the aged listing of individual customer balances and a review of the aged listing of individual customer balances to be performed to assess valuation. Also, what you should do is consider the adequacy of any allowance for credit losses. Also, what you should do is consider the adequacy of any allowance for credit losses. Okay, consider the adequacy of any allowance for credit losses. That do you need to make more allowance or not? What has happened over here is receivables have become higher than the prior year, and there's a good concern that the risk creditworthiness of some customers is a legit concern here. There's a risk that some receivables may be overvalued. There's a risk that some receivables may be overvalued. So if they are not recoverable and adequate allowance for credit losses is not made, and if they are not recoverable and adequate allowance for credit losses is not made, so what you should do, extend the post-year and cash receipt testing and review of the aged list of individual customer balances. Also, what you should do, consider the adequacy of any allowance for credit losses. Also, consider the adequacy of any allowance for the credit losses or receivables. The first, what you should do, extend the post-year end and cash receipt testing, a review of the aged list of receivable individual customer to be performed to assess the valuation. Also, consider the adequacy of any allowance for credit losses. Right? Consider the adequacy of any allowance for the credit losses. So that is about this. Next, we look into revaluation of property. So, Reorder has a policy of revaluing its land and buildings, and this year has updated the valuation of all land and buildings. So, Recorder has a policy of revaluing its land and buildings. These values have been updated during the year. Property, plant, and equipment could be under or overvalued if the recent valuation has not been carried out, accordance with IAS 16 property, plant, and equipment. So what happens over here is your property, plant, and equipment can be overvalued. Why will it be overvalued? It can be overvalued because if the revaluation has not happened with regards to IAS 16 and disclosures have not been made in the financial statements, there's a good chance, okay, not been made, there is a good chance over here. If Recorder has a policy of revaluing its land and buildings, and these valuations have been updated during the year. So property, plant, and equipment could be under or overvalued. Right? So if the recent valuation has not been carried out in accordance with IAS 16, plant and equipment and adequate disclosures may not have been made in the financial statements. So what happens is recorder has a policy of revaluing its land and buildings. And if these revaluations have been updated during the year, property, plant, and equipment could be over or undervalued if the recent valuation is not in alignment with IAS 16. So see, IAS 16 is a standard that you would have studied in FR, which ensures that the revaluation is done based on a certain set of rules and regulations. And if that is not the case, then it is incorrect. So as a solution, what you should do is discuss with the management the process adopted for undertaking the valuation, including whether the whole class of the assets was valued and if the valuation was undertaken by an expert. Okay. Next, what you should do is review the disclosures of the revaluation in the financial statements for compliance with IAS 16. Second, also you have to review the disclosures of the revaluation in the financial statements for compliance with IAS 16. First is what you should do is discuss with the management the process adopted for undertaking the valuation. Second, including whether the whole class of asset was revalued and if the valuation was undertaken by an expert. So the valuation also should be done for the entire class and an expert should do that. It should be done by an entire class and who should do it? Expert should do it. Who should do it? Expert should do it. Who should do it? Expert should do it. Yeah, okay. That is the problem here. You have to ensure that checking is done. During the year, directors have has been paid a significant bonus and they have included this within wages and salaries. Separate disclosure is required by local legislation. So basically, local legislation requires a separate disclosure. So there's a risk that the director's disclosure is not incomplete. That is the risk. That there's a chance that you guys did not disclose the director's remuneration. The directors each paid a significant bonus and a separate disclosure is required by local legislation. So what is the solution to this? Discuss this matter with the management and review the disclosures in the financial statement to ensure compliance with local legislation. Okay, the directors have each been paid a significant bonus and a separate disclosure of this in the financial statement is required by local legislation. So what you have to do, the director's remuneration disclosure will not be complete if this has not been done. Right? It will not be complete. Completeness will be an issue. If the disclosure has not been done, it will be incomplete. If the disclosure has not been done, it will be incomplete. Okay, so what you should do is discuss the matter with the management and review the disclosure in the financial statements to ensure compliance with local legislation. And if the bonus paid is not disclosed in accordance with the relevant local legislation, discuss this matter with the management and review the disclosures in the financial statements. Also, what you should do is discuss the matter with the management and review the disclosure in the financial statements. Now, discuss this matter with management and also review the disclosure in the financial statement. What you should do is you should review the disclosure in the financial statements. Also, what you should do is discuss this matter with management. You should first discuss the matter with management and second, review the disclosure in the financial statements. Discuss the matter with management. First, you should do is disclose the matter with management and review the disclosure in the financial statement. What you should do is discuss this matter with management and second, review the disclosure in the financial statement. And second, what you should do is review the disclosures in the financial statement. Right? Discuss the matter with management and review the disclosures in the financial statement. That is all about this. Okay, so these are some of the points here with regards to the audit risk and legislation. Next, what we'll do some audit procedures in order to place reliance on perpetual counts. Okay, in order to place reliance on perpetual counts, what are the audit procedures? To place reliance on perpetual counts, what are the audit procedures? Okay. Okay. Moving on now, we look into this here. Audit procedures. What about audit procedures here? Looking into the audit procedures now. What about this? So for inventory counts, what are the audit procedures that we look into? Firstly, we look into the action. What you should do, you should at least attend one count. What you should do, you should attend. The action is you should attend. What you should attend one count. Okay, what you should attend one of the counts. Why should you attend? Okay, why you should attend? You should attend to review whether the controls are adequate. to review whether the controls are adequate. That's it. Second, what you should do, check the schedule. What you should do exactly, confirm that all the lines have been counted once. So what you should do, you should review. What you should review, review the schedule of counts. What you should review, the schedule of counts undertaken, right? Schedule of counts undertaken, right? Schedule of counts undertaken, right? Schedule of counts undertaken. So first is what you should review. Review the schedule of counts undertaken, right? To ensure that all of the inventory lines have been counted once a year. To ensure all the inventory counts have been counted once a year. To ensure all the inventory counts have been accounted once a year, right? To ensure all the inventory counts have been accounted for once a year. To ensure all the inventory counts have been accounted for once a year. To ensure all the inventory counts have been accounted for once a year. Okay, that is the first thing. Next, what we'll do is we will review. What will we review? We will review the adjustments. Next is we'll review. What we will review? We'll review the adjustments. Okay. Why will we do that? To gain an understanding on the level of differences arising on a month by month basis. Why will we review? To gain an understanding of the level of differences arising on a month by month basis. So next is we will review. Review what the adjustments made to the inventory records to basically ensure to gain an understanding of the level of differences arising on a month by month basis. Right? Why will we do that? To gain an understanding of the level of differences arising on a month by month basis. Okay. Next. Next, what we will do, we will discuss. Next, what we will do, we will discuss. What will we discuss and with whom will we discuss? We will discuss with the management. Okay. What will we discuss? We will discuss how they will ensure that the inventory will not be under or overstated. And if the difference consistently rise, this should be indicate that inventory records are not adequately maintained. What I will discuss with them, right? That how will they ensure that the year end is not over or understated? Because if significant differences arise, this could indicate that the inventory are not adequately maintained. To ensure if the inventory is adequately maintained, to ensure if the inventory is adequately maintained. Okay, to ensure if the inventory is adequately maintained. Why should we do that? To ensure, right? To ensure that the inventory will not be over or understated. Why we are doing it? To ensure inventory is not over or understated. Okay, why are we doing it? To ensure inventory is not over or understated. Next, consider attending. What we should do? We should consider. What we should do? Consider attending the inventory count. Right? Why? So that to undertake the test counts of inventory. From where? From records. Okay, from where? From records to floor and from floor to records. Right? Records to the floor and from floor to the records. Why? Why would we want to do that? What is the benefit of doing that? To confirm the existence and completeness of inventory. Right? So we will attend a count and we will undertake the test count. We ourselves will do the count from the record to the floor and from the floor to the record. Why are we doing all these things? To confirm that the existence and completeness of inventory. To confirm the existence and completeness of inventory. Why are we doing it? To confirm the existence and completeness of inventory. To confirm the existence and the completeness of inventory. Okay. To confirm the existence and completeness of inventory. Okay. To confirm the existence and completeness of inventory. Next, we'll look into substantive procedures for directors' bonus and remuneration. What are the substantive procedures for directors' remuneration and bonus? Okay. So first of all, what we will do? Okay. Okay. First, what we will do? We will obtain. What we will do first? We will obtain. Okay. First, what we will do is we will obtain. What will we obtain? We will obtain a schedule of the director's remuneration. We'll obtain a schedule of the director's remuneration. Okay. What we will do, we will obtain a schedule of the director's remuneration, including the bonus and next what we will do, we will cast. Here including the bonus paid and then we will cast the addition of the schedule to confirm accuracy. First we will obtain the director's remuneration and then we will cast. Why? To confirm the accuracy. Why are we doing all this? Just to confirm the accuracy. Why are we doing all this? To confirm the accuracy. Why are we doing all this? To confirm the accuracy. Okay, so obtain a schedule of the director's remuneration, including the bonus paid and cast the addition of the schedule to confirm accuracy. So once we'll get the schedule, then we will cast it. That means we'll add it up just to ensure accuracy. Next, what we will do? We will agree. What we will do? We will agree. What we will agree? The individual bonus payments. What will we agree? Individual payments to the payroll records. Right? We'll pick individual payments and to the payroll records. Right? Just to make sure that it has been done in an accurate way and in a complete way. Okay. Next, what we will do? We will inspect. What will we inspect? What should we inspect? We should inspect the bank ledger and the bank accounts. Bank ledger and bank accounts. Why are we doing all this? To confirm the amount of each bonus paid. Why are we doing? To confirm the amount of bonus paid. To confirm the amount of bonus paid. Next, review. What are we reviewing? Board minutes. What are we doing? First is we are reviewing. What are we reviewing? We are reviewing the board minutes. Why are we reviewing it? Why are we reviewing it? To confirm whether the additional payments relating to the year have been agreed. Right? First, then what we're doing, we're reviewing. What are we reviewing? Board minutes. Why? To confirm whether any additional payments relating to the year have been agreed. Okay. Whether it has been agreed. Second, obtain. What are we going to obtain? A written representation. What are we going to do? We're going to obtain. What are we obtain? A written representation from the management. Why? Why? To confirm the completeness of the remuneration. To ensure to confirm the completeness of the remuneration. Next, we are reviewing. What are we reviewing? Disclosures. What are we reviewing? We are reviewing disclosures made of the bonus and assessing whether they are in compliance with local legislation. And what we are doing, we are assessing whether they are in compliance with the local legislation. Okay, and we are confirming whether they are in compliance, with the local legislation. So we are reviewing the disclosures made and we are assessing whether they are in compliance with the local legislation. Okay, whether they are in compliance with the local legislation. Okay, whether they are in compliance with the local regulation. Okay, whether they are in compliance with the local legislation. Next, auditor's responsibility in relation to laws and regulations. So let's look into this. Auditor's responsibility in relation to laws and regulation. What about this? Okay, auditor's responsibility in relation to laws and regulation. Okay, so what are the auditor's responsibility? Whenever we talk about law and regulation, what is the auditor's responsibility? First thing what the auditor has to do is look for any material non-compliance. So the first job that he has is to look for material non-compliance. Is first to identify any non-compliance. That is there any non-compliance or not. Second, get evidence. Right? The auditor must obtain the evidence regarding compliance with laws and regulations. Next, the auditor must perform audit procedures. Next, what the auditor should do, he should perform audit procedures. He should perform audit procedures to identify non-compliance. Perform audit procedures to identify non-compliance. Next, where the auditor becomes aware of non-compliance, they must obtain an understanding of the act and circumstances in which it occurred and evaluate the effect of the financial statements. Where the auditor has become aware of non-compliance, he should obtain an understanding of the act and circumstances that what really led to the non-compliance. Then the auditor must report this non-compliance also to management that see this non-compliance has happened. Then what he should do, he should report it to management also. Okay. If it is and if the non-compliance has a material effect, then he must modify the audit opinion also. He should then modify the audit opinion as well. And finally, the auditor must consider whether they have any legal or ethical responsibility to report non-compliance. He should see if it has a legal or ethical responsibility to report non-compliance. You should see whether he has a legal or ethical responsibility to report non-compliance. You should see whether he has a legal or ethical responsibility to report non-compliance. Okay, so firstly, the auditor must perform all the audit procedures to help identify any non-compliance. Number one. Second, obtain evidence regarding compliance for those items to which has a direct effect on the financial statement. For those items, he must obtain a sufficient appropriate evidence. Next, the auditor must perform audit procedures to help identify non-compliance. Next, where the auditor becomes aware of non-compliance, he must obtain an understanding of the act and circumstances. Next, the auditor must report non-compliance to the management. Second, if the non-compliance has a material effect, the auditor must modify the audit opinion. Next, the auditor must consider whether they have any legal or ethical responsibility to report non-compliance. The auditor must consider whether they have any legal or ethical responsibility to report non-compliance. Right? Whether they have any legal or ethical responsibility to report non-compliance. So this is about the auditor's responsibility in relation to laws and regulation. Right? Firstly, identify non-compliance. Second, obtain sufficient appropriate audit evidence. Third, perform audit procedures. Then perform audit procedures. Obtain sufficient appropriate evidence for those matters which have a direct effect. Perform audit procedures. Next, obtain an understanding of the act and circumstances. Report non-compliance to management. If the non-compliance has a material effect, modify the audit opinion, and the auditor must consider whether they have any ethical or legal responsibility to report non-compliance. The auditor must consider whether they have any ethical or legal responsibility to report non-compliance. Whether they have any ethical or legal responsibility to report non-compliance. Okay, whether they have any ethical or legal responsibility to report the non-compliance. So identify it, obtain evidence for the matter that if it have a direct effect, perform audit procedures, obtain an understanding of the act and circumstances. Next, report non-compliance to management. If the non-compliance has a material effect, the auditor must modify the audit opinion, and the auditor must consider whether they have any legal or ethical responsibility to report non-compliance. Consider whether the auditor has any legal or ethical responsibility to report the non-compliance. Does he have any legal or ethical responsibility to report the non-compliance? Okay, whether he has any ethical or legal responsibility to report the non-compliance. That is all about it. Right? The auditor must obtain audit procedures to help identify non-compliance. The auditor must obtain sufficient appropriate audit evidence to the matters that have a direct effect and perform audit procedures which help identify the non-compliance. Then obtain an understanding of the act and circumstances which cause the non-compliance. Report the non-compliance. If the non-compliance has a material effect, then the auditor must modify the opinion, and the auditor must consider whether they have any legal or ethical responsibility to report the non-compliance. Okay, so that is all about the auditor's responsibility with regards to non-compliance. Okay, so this is yet another question.